Hi Sebastian, great to be speaking to you once again. Now, this conference is arguably one of the largest in your sector. How is Endeavour differentiating itself to compete for investor capital?
Hi Scott, good to chat once again. To tackle your question head on, the good news is that compared to a year ago, given our increased size, we are now being compared to senior gold producers. Put simply, I think we have now 4 key attributes that probably distinguished us. First, it's all about the portfolio. In the past 5 years, we have built today's high-quality portfolio. We have robust assets which allow us to produce roughly 1.5 million ounces at a competitively low all-in sustaining cost of below 900 per ounce. And we also have high-quality growth projects which allow us to both increase production and maintain our low group all-in sustaining cost, as well as some exciting exploration prospects. Second, we have a strong balance sheet with a net debt to EBITDA ratio standing now close to 0. And I think those 2 first points are key factors that makes us a resilient business, which is exactly what long-term investors are looking for. Third one is we are currently offering one of the most attractive shareholder returns program in our industry, with continued active buybacks and dividends. And fourth is probably our valuation. We're currently trading at one of the highest free cash flow yields across our peer group, and we are attractive on a number of other metrics as well.
So Sebastian, those are all great points. Perhaps diving a bit deeper into each one. On the portfolio quality, you've posted very strong operational results for Q2 and for the first half of the year. Tell me more.
Well, Scott, all of our mines are performing well and are on track to meet guidance, which is the good news. Production in Q2 was up 18% over Q1. And to put that into perspective, with over 400,000 ounces produced in Q2, that's an annualized run rate of over 1.6 million ounces, while this year guidance is 1.4 to 1.5 million ounces. So we're clearly on track to achieve the top end of production guidance. And on the other side, our costs are also on track with guidance. I think that the most significant increase has come from our Houndé mine, where we are seeing the benefits of the high-grade discoveries like Carry Pump that we made over recent years. We've also been helped by, I must say, the late start of the rainy season. Sometimes you can be lucky, which has allowed us to continue to mine and process in more favorable conditions. I think also a key factor is our success has also been the rapid integration of the Teranga assets, which are both performing well, and we've also had the benefit of a full quarter of those assets in Q2. Additionally, we are seeing the synergies which are starting to come through. $100 million of total synergies from the acquisitions of both Semafo and Teranga. And I think this strong operating performance has translated into a very robust set of financials. Our operating cash flow increased by 45% over Q1 to reach roughly $300 million, and our adjusted net earnings nearly doubled to reach roughly $180 million.
Now, Sebastian, your all-in sustaining costs have been coming down while industry costs are rising due to inflationary pressures. What's favouring Endeavour?
Well, the Teranga acquisition, through it we acquired 2 low-cost mines, especially our flagship Sabodala-Massawa mine in Senegal. Q2 was the first quarter where we saw the full benefit of these mines, as they were only consolidated for a month and a half in Q1. But also at Houndé, we've seen the benefit of our exploration program, which discovered the high-grade Carry Pump deposit, which we recently put into production. The high-grade ore at Carry Pump has been able to displace ore from other higher cost sources and therefore helps us to reduce the all-in sustaining cost. We are also starting to see the full benefit of synergies from the 2 acquisitions we made. We're seeing the benefit of the large renegotiation on our main key contracts on the supply chain and the logistics side following the Semafo and the Teranga acquisitions.
So Sebastian, compared to a year ago, you're obviously a much larger company. But from what I see today, you offer a more complete investor proposition with shareholder returns and a healthy balance sheet. But a common theme is your continued focus on exploration and growth, which has been your bread and butter. So how is this progressing?
Well, as you know, exploration is a key focus area for us, given we are operating in one of the most prospective regions in the world. West Africa has been the second largest gold producing region in the world and the most prolific. In fact, exploration is both a short-term and a long-term catalyst for us. The reason we have had such strong operational performance in Q2, as I mentioned, is the Carry Pump discovery for Houndé, made 3 years ago, which went into production late last year and allows us to have very low all-in sustaining cost at Houndé. The team has been very busy also this year, taking advantage of the dry seasons. We have drilled over 300,000 meters across the group in H1. We've had very good results from the drilling program, in particular at our 3 cornerstone assets, such as Ity, Houndé, and Sabodala-Massawa mines, with new discoveries, in fact, at each of them. And it's been the same also for our Fetekro project. So look out for new resource estimates later this year for each of them. Good success there. And I think that on the back of this strong success, we feel comfortable to be able to deliver over 2.5 million ounces of indicated resources for the group for this year. And just to give this 2.5 million ounces some context, it's an important number for us as it represents significantly more than our expected annual depletion, which will be around 1.5 million ounces for 21. We will also be announcing later in the next few weeks our new 5-year exploration strategy. If you recall, the last, the one from 2016 to 2021, aimed to discover 10 to 15 million ounces, which we are on track to achieve this year and complete this year. So we're now preparing for the next one from 22 to 27. And regarding our growth projects, the Sabodala-Massawa Phase 1 expansion project is advancing well and on track to be completed by year-end. And in parallel, we've been working on the DFS for the Phase 2 of this project, which is expected by year-end as well. And of course, the DFS for our Fetekro and Kalana Greenfield projects are also making good progress. Both are expected in the upcoming quarters. And I think it's no coincidence that all the DFS will be completed around the same time. As you know, all our projects have to compete internally for capital. So big decisions, will be made at the end of the year and beginning of Q1.
So now let's touch upon the balance sheet. You've been focused on deleveraging yourself to make Endeavour a resilient business. Tell me more about that.
Well, for us, the balance sheet is, I would say, no longer an issue. If we look back to June of last year, we had nearly $500 million of net debt and a net debt to EBITDA leverage ratio of about 1 time. Today, our leverage ratio is close to 0, and net debt was approximately $75 million at the end of Q2. In fact, if we had wanted to, we could have been in a net cash position by now. With our capital allocation framework, we're taking a balanced approach where we're continuing to strengthen the balance sheet on one side, while also continuing to invest in exploration, in our growth projects, and crucially in rewarding our shareholders, through buyback programs. We believe that the combination of all this is the right recipe for long-term success, and that's what we've been focusing on.
Now, this may be a good segue into your shareholder return program, which has now become a significant component of your capital allocation. It's very clear from your June Investor Day that Endeavour has a very shareholder-friendly returns program. How important is this to your corporate strategy?
Well, this shareholder-friendly return policy is a key part of our strategy because our shareholders have been very patiently waiting for us to be into this strong free cash flow position. It's now time for us to reward them. As you mentioned, in June, we announced a minimum progressive dividend policy with a target of distributing at least $500 million to shareholders through to fiscal year 23, and if gold remains above 1,500. This is aligned with our expected production growth, so we're rewarding shareholders with a growing dividend, both in nominal terms and of course on a per share basis. This started earlier this year when we paid our maiden dividend of $60 million for the 2020 fiscal year. And with our Q2 results, we announced a dividend of $70 million for H1 2021. Our minimum commitment for this year was $125 million. So as you can see, the 21 interim dividend demonstrates our intent to pay more than the minimum. In addition, given the attractiveness of our stock price, we've been actively buying back our stock since the program was launched in April. To date, over $90 million has been purchased, and we intend to keep the program going as long as we feel it's an attractive investment for our shareholder. We now have all the right ingredients to continue to deliver excess shareholder returns. We have a healthy balance sheet, our operations are performing extremely well, and the gold price remains healthy. So our shareholders have been, again, patiently waiting for us to be in cash flow mode. And now that we are in this phase, it is pleasing to see that we are able to deliver on our promise.
Now, you mentioned you believe you're still undervalued and there may be a re-rating opportunity. Can you give more color on this?
Well, I'm sure that every company at this conference believes that they are undervalued. And that is most likely true, as there is currently a large disconnect between the gold price and gold equity valuations. We don't think the market has realized the full cash generation potential of the portfolio we have today, as well as the exceptional organic growth opportunities with our projects and the exploration potential that we foresee. A good indication is the fact that we continue to be active with our buyback program, which means that it exceeds our investment hurdle rates, which is 20% for new projects.
Seb, there's been a lot of emphasis placed on obtaining indexation following your LSE listing. How big a catalyst is it and how's it tracking?
The FTSE indexation was always one of the main reasons behind the premium listing on the LSE, and we were therefore very pleased with the FTSE announcement earlier this month, stating that we will be included into the FTSE 250. The rebalancing of the index is expected to become effective around the 20th of September. It's a big catalyst, as from the notes we've seen by the index analyst, this is expected to create an incremental demand of around 10% of our shares outstanding. And beyond indexation, our premium listing on the LSE is also enabling us to attract UK generalist funds. We have become the largest pure gold producer on the premium segment of the LSE, and we are filling the gap left in the London market since Randgold left. We're starting to see now some good daily trading volumes on the LSE, with already 10% of our register having moved to the UK, and we expect this trend to continue progressively.
Now, switching to ESG, in your recent capital markets event, you laid out your ESG strategy. Something that caught my eye was the commitment to a reduction in 30% emissions intensity by 2030. Can you give us some insight on how you plan to achieve this?
Well, Scott, being a trusted partner is an integral part of our business strategy. While ESG might be the current flavor of the day, this forms part of our social license to operate. It is not new to us. It has been core to our strategy for years and years in our operations. Mining in emerging market is probably one of the most impactful industries when it comes to the social part of ESG, contributing to local communities, growing jobs and knowledge, and adding economic value in the host countries. We are now one of the largest mining companies in West Africa and also a significant employer in that region. With that, comes a huge responsibility that we are very conscious of. Our operations contribute increasingly to the revenues of the countries where we operate, as well as being vitally important to the people we employ and the communities that are around our mines. While our social and economic contributions are important and immediate, however, we also need to address our environmental impact, possibly one of the greatest challenges the world faces today. We're committed to do the work necessary to align our business with the goals of the Paris Agreement and the Science-Based Targets initiatives. And to reinforce this commitment and our ultimate ambition of net zero by 2050 and our goal of 30% emissions reduction by 2030, we've done two things. The first is to include a carbon reduction strategy as part of our long-term executive compensation scheme. And the second was to start a detailed action plan across our portfolio to reduce our emissions. From an intensity perspective, taking that total on a per ounce basis, we are amongst the lowest emitters in our peer group, and all our mines perform better than the industry average. We have identified 8 levers to reduce greenhouse gas emissions, and work is already underway investigating those opportunities. From the mining perspective, we are looking at the use of cleaner fuels and ways to optimize the use of our fleet. There are additional levers from our electricity use, including improved generating capacity, increased efficiency, and switching also to renewable power. We see solar as forming a core part of our energy mix going forward and have identified potential for up to 150 megawatts of solar across our operations, starting with our Houndé mine in Burkina Faso.
So Sebastian, it looks as though solar will be key in reducing energy consumption going forwards. Why do you like solar, and why are you choosing to do this at Burkina Faso?
Well, solar is also a key component, in fact, of Burkina Faso's national agenda to electrify the nation. The president's goal is to have 80% of the country electrified over the next 5 years, and we see ourselves as a partner playing a role into this policy. We believe this is the most effective strategy for us and also the best allocation of capital across the different opportunities we have in the portfolio. So if we look at the Houndé project in more detail, we estimate a solar plant could reduce our power cost by 20 to 35% and lower Scope 2 emissions by 35 to 50%. We also plan to go beyond the mine and assist with rural electrification, and I hope to announce more details on these plans later on in the year. What I like the most about solar is that it's a really good example of a sustainability project that ticks for me multiple objectives. It's good for our operation as it reduces our cost and improves efficiencies. It reduces our CO2 emissions, so it's good for our planet. It supports our local communities as they are electrified with renewable energy, which future-proof them. And finally, it's aligned with the government's national agenda towards access to electricity and their own contributions to the Paris Agreement.
So Sebastian, where do you go from here? What are the next steps for Endeavour?
Well, Scott, it's simple. Now that we have established ourselves as a resilient business, we want to continue to generate healthy cash flows and discover new answers. And this combination will allow us to reward our stakeholders over the long term.
Well, thank you, Sebastian. It's been an absolute pleasure.
Thank you very much, Scott.